Anupam, you let me know when we want to start.
Yeah, I think once again, good evening to all the participants. And this is our second call in this month. The first call was on the August 18th, where we have covered the markets and the mutual funds. And in this, we will cover as the heading of the presentation is why qsif is gathering momentum. So we will review the qsif strategies and the strength behind that, all the qsif products, and also brief introduction about the new fund of fund. Over to you, Sandeep.
Yeah, thanks, Anupam. So, frankly speaking, as Anupam rightly said, this is the second monthly call. Last month, on the last monthly call, we talked about market. I thought let's cover briefly for maybe 2 minutes or so, and then we come to SIF. So we have seen good amount of rally in the market, and the first April when we turned cautious to optimistic on the market, and we said it's a time to capitalize, not capitulate. Since market has done reasonably well, now we believe market is getting into some amount of consolidation phase, which means it can continue to hover around these levels, small correction, some up move. But good news is worst is behind us, which means stock specific opportunity will continue. And we strongly believe that globally that anti-AI theme is gathering momentum. And obviously, should be the biggest beneficiary because India suffered a lot when the AI theme was going on for last 6 to 8 quarters. So we should be logically beneficiary. So we now looking at when we're talking about consolidation, we are more looking consolidation and small correction in the SMIT category, which we are very bullish. That does not mean we're turning negative. It can get into a consolidation there because we have seen extraordinary spike in volumes happening on the SMIT category as compared to Nifty. So the margin of safety in the Nifty stock or top 10 names becomes slightly more important at this stage. So we continue to look for opportunity in the neglected territory, deep value stock. Okay. So when we launch our product on the silver ETF, we talked about there's the precious metal cycle bottoming out at silver in particular, which has done reasonably well after our call a month back. Now, obviously, we have been talking about India outperforming versus gold also, despite the recent up move. But if I have to look at from even from the current level and next 3 years view, we have to take, then Indian equity has a potential to outperform gold, despite we are even slightly more constructive on the precious metal space. And obviously, under research, hated territory name should be the driving force. Now, if I have to really talk about what exact sectors which we have looking at, so as you are all aware of, we have been bearish in the banking as a space for nearly 4 years. The top-notch market cap company we don't own in our portfolio. We only participate only from a purely from a opportunistic trades sort of thing rather than getting into core holding. So we continues to remain our optimistic outlook towards NBFC and AMC company. We think this is a two space which outperform the banking in a big way, both public sector as well as private sector. In fact, small banking names you have seen they have given far superior returns. So I think the smaller banks name has potential to outperform the large private sector names also. So when we continues to remain bullish on large infra, energy theme, which is very important, data center theme. If I have to talk about IT, we turned slightly more optimistic for last 2 months or so because we felt they have reached now the neglected territory, hated zone where people have virtually given. But ultimately, we have to identify who could be the AI implementer. We need somebody to implement these theses. So instead of looking at IT services, we can call it AI services. Telecom as a sector, pharma, generic, media entertainment is very small, but they are also trading now in a hated zone. Hotel stocks. Some of these are themes which we have liked it. Now, if you really look at this is the exact positioning of our portfolio because last few months we have under-owned manufacturing given the turmoil of what is happening on the geopolitical front. So we think there's a more safety which we have played out quite well for us. Now let's come back to we are looking at we just launched our silver ETF. Now we're just launching our income plus, which is already launched on 17. I'll come to that presentation. Let's briefly talk about SIFs. Okay. So QSIF, as we proudly say QSIF, our SIF name is QSIF, and we're the first to launch this product. We talk about QSIF as a cross market and cross asset cross market product, which is a very unique in that sense as compared to mutual fund. This product gives as a money manager more flexibility, where we have opportunity to create 25% naked short. Effectively, what we are saying, we have potential to manage our beta of the respective schemes in a better manner. Okay. Now, globally, SIF type product with various names is gaining momentum, whether you talk about absolute return product or talk about long short or some sort of H1 portfolio, and various names are given because predominantly these products are sold more from a wealth preservation point of view. And even in India, SIF has been looked at right now more from a conservative investor because of pure beta management techniques which we can use. So let's understand key differentiation between mutual fund and the SIF. This is the thesis which we'll explain going forward. Now, if you really understand in mutual fund, what we do, we call it discretionary active strategies. Okay, which means a money manager has a completely discretionary active strategy, and that's the way we play through low frequency analytics. Now, when we talk about low frequency analytics, which means it is from a longer term perspective, which we look at, and it is dependent on the earning season, quarterly numbers, monthly number, any data point which is coming over the frequencies on the lower side is considered as a low frequency analytics, and where the QSIF side product, we are more focusing on the high frequency analytics. The most important differentiation between mutual fund and SIF will be we are introducing the thesis of systematic active investing. This is the concept which has gained momentum globally. When we talk about systematic, it means you're talking about some amount of process. Obviously, active is the theme which we obviously have to work it out. When you talk about systematic active investing, basically we are combining our market outlook and adding more focus on the risk mitigation tool. And that's the reason why we introduce high frequency analytics. Because if you have to talk about, let's say, uh, we cannot say or quantify the risk for 8 years, 10 years, or 5 or 10 years perspective. And you talk about mutual fund investment, but can we quantify 1 or 2 quarter with more confidence the risk aspect? Answer is yes. And if we cannot quantify your risk profiling from longer term perspective, and when we can talk about SIF, we have to quantify, which means our investment horizon used as a product is largely meant from short term and medium term from an investment point of view, where we can combine. I cannot take 10 years call, 5-year call in the QSIP type portfolio, where mutual fund we can take because we cannot manage the risk. So very big difference will explain you in through more slides. Okay. Now let's understand these are the all 5 products are we have launched, 2 in the hybrid category and 3 in the equity side. 2 debt products are still pending. We think they're not viable in today's context, and hence we have not launched. So we have complete the quota, and we are the first to launch most of the product in the industry. Now, if I have to talk about this is our own experience in managing high frequency analytics through Quantamine and our own AMC experience, which started in 1996. Now let's understand the difference. Okay. As I was explaining a bit earlier, that a mutual fund, we talk about core holdings. Okay. So your long positions are core. So 70%, 80% are your core holding, and 20, 30% are your non-core position. Here in QSIF, we are talking about 70% positions as a tactical law, and 30% are only from the non-core perspective. Okay. So here the equation reverse. We are talking about only about tactical long and opportunity short. Why we are talking the word opportunity short? Let's understand when you talk about long short portfolio. Here, regulator has given us flexibility. If we want to run this product like a normal mutual fund, yes, we can run, but we have only option to excise the 25% short position. There is no compulsion. Very important to understand. Globally, a lot of people have concern about H1 will become some sort of bankruptcy sort of thing filed. People talk about this belly up thesis in the market for a long period of time. The risk which you have to understand when you have a compulsion to run long short portfolios simultaneously in a massive bull run market, you have a potential to lose something on the short side in a big way. And then some of these long fund, long short fund globally also have leverage as a component, which make it these products more riskier. Now here, regulator does not allow us to take any leverage exposure. Rather, derivative instrument, which we consider as from a more from a risk perspective, without leverage, should not be considered as dangerous as people start believing the moment you use the word derivatives. So we are talking about purely opportunity short because India is in a structured bull run. And currently, we are now looking at India also as cyclical uptrend also. And we have seen last 2 years what will be a cyclical downtrend. And April onward, that cycle has changed, which means even from a longer term perspective, keeping extraordinary short is not going to be advisable. That's the reason we at Quant, when we manage qsif, we are using the word only opportunity short. It's more from a risk perspective. Now, this is the how our investment thesis have evolved over a period of time. How the SIF we are launching is a small positioning perspective. I'll explain to you what you mean by high frequency analytics, how we looking at the markup as a data points. Okay, some of the stuff I have covered, but briefly. Okay, now these are the five products which we have talked about. We have also tried to compare with this mutual funds because you are used to certain thesis in mutual fund. Okay. Now, if you talk about the QSIV long short, we are saying equivalent to a flexi long short product. Okay. So how you understand flexi cap? Here you have added advantage of long short position apart from running a category. You are familiar with the BAF or DAF as a concept. You're talking about hybrid long short is a long short BAF. Okay, so a similar manner how you manage that category, and similarly X100 category is more from a Smith point of view, Smith long short, and multi-asset and multi-set long short, and so is the case with the sectoral. Now let me explain the most important aspect, the tax treatment. Okay, now something very unique out here. If you're all familiar with the long-term taxation is 12.5% if you hold more than 12% and you have more than 65% equity exposure. That's the way it quantifies as a 12.5%. So all our equity schemes in the SIF qualify for the long-term perspective at 12.5% and the 1 year perspective. The most important aspect is here that our hybrid product, which is QSIF hybrid equity long short and QSIF active asset allocator long short fund, both are hybrid product. And it's we as a house have used the word for other category. But if you are aware of from a taxation point of view, the way income tax defined, if it's a listed space, then you do get an advantage of 12.5% if even your scheme is less than 65% equity exposure. And that's the reason the QSIF hybrid and QSIF active asset allocator becomes a very interesting product, even from a taxation point of view. Though we are talking about other taxation, but we are getting the benefit of 12.5% long term out here. So the important thesis to understand, a lot of confusion was there. So we thought we just clarify that part with the in a very candid manner. Okay. Now, when we talk about the comparing, it's a mindset to compare mutual fund versus SIF. So obviously we are trying to again giving you some amount of hypothetical scenario. So how SIF versus mutual fund will compare, and we instead of getting in the industry perspective, this is what we feel as a quant mutual fund schemes and quant equity inclusive centric fund, how they will obviously in a raging bull market, mutual fund will scheme will outperform because they're largely invested from a longer term perspective. Potential of underperformance QSIP could be there in raging bull market, but which is not the case in our case. If you look at when we talk about performance, our equity schemes, even in last 4 months of good bull run, have not underperformed. They have actually outperformed. So this is more from academic perspective. And obviously, if you're talking about a scenario where market is underperforming, market is in a correcting phase, or markets are very volatile, those are the scenario where QSIP type product should give you a better performance. And this is one of the reasons why we are saying that going forward, you should have a good blend of both mutual fund as well as SIF in your portfolio, because mutual fund and SIF put together gives you far better stability, lesser drawdown, lesser volatility, better diversification, and hence a superior risk adjusted return. We as a house have been talking about you should have 50% exposure in mutual fund and 50% exposure in SIF, which means if you already have invested in the mutual fund for a longer period of time, time has come to increase your exposure in SIF exponentially so that in next 3 to 5 year perspective, you have blend of both. Now, let's understand the product. This is the first equity long short product which I want to explain you. Now, it's a what is interesting out here. We call it the long short flexi. Okay, what we do in flexi on the mutual fund side, it is basically it is sector agnostic thesis, market cap agnostic thesis which you play as a money manager within equity. We get highest flexibility in the flexi cap category where we can have liberty to rotate from large to mid or mid to small. And something similar you we continue to do out here in the long short. But here over and above flexi cap, we have benefit of a long short strategy, which means we can manage beta of the flexi cap portfolio far superior than the mutual fund portfolio. That's a very important aspect. You have to understand we are not talking about cutting down the risk completely. Risk is a very broader term. And here we are talking about just controlling the beta of the portfolio, which is also part of the larger risk basket. So it means up to certain extent, you can reduce your risk considerably. What is important to understand is that when regulator defines that if you are, let's say, invested in the flexi cap and you are bullish on the market, you have 100% equity exposure. The moment you realize if something is not right on the market, or your data points are showcasing the market has potential to correct from the current level. And if you want to increase your naked short exposure, first you have to cut down your exposure from 100 to 75%. Then you can take another 25% short exposure, which effectively means your long and short exposure, gross exposure put together cannot exceed 100, which means you cannot have any leverage position. That's the first point. And obviously, if you have 75% long now and 25% short, you have cut down your exposure significantly by nearly 50%, 75 minus 20, 50%. So approximately you are able to control nearly 50% you have cut down the exposure perspective. That's very important to understand. So next exposure has come down drastically. That's a key differentiation and so is the case with any other product. Now, how we are as a quant or qsif are going to manage our equity long short portfolio or we call it the long short flexi. Obviously, minimum requirement to maintain our equity will be around 65%, which we're doing for a while. And if market has potential to consolidate, then we can use derivative instrument through either through arbitrage route or we can use through call writing route. Basically, low risky derivative strategy you can adopt. And what is very important for this mindset has to change in India because the first time regulator is giving you a flexibility and really how money management skill set can be identified on the shorting side. You can actually generate alpha by short in the market. Not only when you talk about derivatives, people start looking as a hedging tool. Yes, you can hedge your portfolio, but it's the first time we have now talking about that you, if you're able to identify short positions well, you have ability to generate alpha also by through the hedge route, also called naked short position route, which is a very different perspective. Most of the money managers and most of the retail investors are not used to this thesis. And this is something which we think going forward, the risk adjusted returns becomes more meaningful. So far, it has been more from academic perspective. Best of the wealth manager don't follow it so closely. Now, if risk adjusted returns become meaningful in terms of performance, you will see SIF gaining further momentum down the line, 3 years and 5 years when you see that how the cycle has performed. Because we typically say in 6 year period, suppose you invest typically or 3 times you get a decisive bull run and 3 times you get a decisive bear phase in that period. So effectively, if you get minimum 3 cycle on the long side and minimum 3 cycle on the short side, you can actually have potential to outperform the normal mutual fund schemes also because you have extra edge of shorting, providing your assessment on the short side should be reasonably good. And that's the reason we've introduced the high frequency analytics in our product. So this is the first product on our side. Now let's look at the performance. Ultimately, this is the performance which we have to look at. Now, This fund is more than 6 months old. 6 months is a good track record to gauge. The benchmark has given 2.27% return. QSIF has delivered 13 point nearly 14%. And even you look at 3 months perspective, 1 month perspective, we have given decisive beat to the benchmark, the performances, which clearly demonstrate the strategy which we have used or the techniques which we are using in managing the QSIF long short portfolio has worked very well. And frankly speaking, it's a quite good performance, okay, over the respective benchmark. So here, I think I'm not wrong, benchmark is BSE 500 or NSE 500. So your market has not delivered much in last 6 months, but the product has performing very well. In fact, it is the 1 month, 3 months, and 6 months. It's the best performing product in the entire SIF category. So this is an important achievement from our perspective. Now let's understand the second product, talking about equity X100. Okay, what it means, that here we are talking about SMIT as a category. It's very interesting that within mutual fund, you don't have any scheme which has combination of both mid and small. Okay, despite the index SMIT is there. So we are talking about SMIT as a portfolio, which is very, very unique and is a good opportunity. So we are calling the long short SMIT out here. And again, interesting product is that how well I can manage the beta. So everybody feel really very excited to talk about return they have generated over a period of time, mid and small. When market correct, let's talk about last 2 years. When market corrected, the small and mid has corrected sharply because the beta of these products are on the higher side. Now you look at a product, you are getting a long short split, which means at least 25% of the portfolio is can be protected by hedging or by going naked short on the market on certain stock. Let's say if I'm liking Infosys in a as example sake, I'm long Infosys. Can I short TCS? Answer is yes, you can do it out here, which is not the case in mutual fund. In mutual fund, you can only hedge your underlying. Okay, which means up to large extent you can do either small call writing or you can hedge through options route or through futures route, but you can have 100% hedging can be done. Here, we are talking about a strategy without owning certain stocks or sector, you still have luxury to short them if you are convinced that their fundamentals are deteriorating. The most of the analytics tools which we use are also endorsing a similar mindset or similar perspective, then you can actually generate. So it's a very unique product. Long short, frankly speaking, it is gaining a lot of traction at our end also. And this is what exactly what we are going to do. Again, key differential between equity long short versus SMIT 100 or X100 is that on the shorting side, equity long short has flexibility to short anything in the entire F&O basket. Here we have restriction. Being a SMIT portfolio, the short position can be only in the SMIT category. That's an important thing, and it's very important to understand that currently in the entire 209 stock baskets, majority of the stocks are large cap and obviously mid and small components on the lower side. But we strongly believe as market depth and breadth of the Indian equity market expands, the number of stocks to be parts of the F&O will increase. We as a house have been pitching also the regulator should look into it and allow BSE 500 or NSE 500 stock should be larger as a complete basket of the F&O, and that becomes meaningful. And so we remain confident over a period of time. Even this number of stocks on the mid and small will expand gradually. Now let's look at the fund performance. It's a very interesting product. Okay. Here, the benchmark, if you look at 6 months, the benchmark has only, SMIT benchmark has only given 2.27% return, where we as a QSIF X100 or SMIT portfolio, the long short SMIT has delivered nearly 20.5% return. So it's the case in 3 months, 1 month, 3 months. And again, this is the best performing product in the category in the entire industry is QSIF X100 product. So this is the performance. Let's number speaks, and I will talk about the engine thesis in next few slides. So ultimately, report card matters. Now coming to the another interesting product, the hybrid long short. We are all familiar with the BAF as a product or DAF as a product. What we calling the long short BAF. Okay. When we talk about long short BAF, and if you understand how people manage BAF as a portfolio, uh, people typically have anywhere between 30 to 40% net equity exposure. Let's say average 35% net equity exposure BAF as a category has been holding. And this category has done extremely well from the low risk appetite clients and has generated uh, a lot of interest in the industry. Now we are introducing the long short BAF, which means our hybrid product has now opportunity that you can have 35-40% equity exposure, and over and above you can have a long short advantage. So it's a very unique in that sense. Now it's up to us how you want to run this product. You can run in a very aggressive manner or you can run a very conservative manner. We have taken a middle path. Okay. When I say we have taken a middle path, we are not looking this product just from a arbitrage plus or fixed income plus product. We are, because if you use any of these techniques, then you are not optimizing the true benefit which regulator has given to us in terms of 25% naked short position. The way I look at our strategy is very clear. The equity exposure should be in the range of 35 to 40%. We can use all low risk strategy in terms of call writing, and even we can write the puts also to small extent if the outlook is there. And something similar, if you want to expand through walls route or you want to route through a walls arbitrage route, you can utilize. You can also look at the pure cash future arbitrage, or you can also look at some of the other low risk strategy within the derivative segment, and you can cut down your risk and you can have opportunity to generate small alpha, and you keep on accumulating this alpha. But the way we are strategizing this product, if I have to talk about, let's say, last next 6 years perspective, I think this strategy of long short BAF has potential to perform very well within the hybrid category. And after 6 years, you realize, as compared to any other strategy which we can talk about, or FD plus or arbitrage plus, then this product will give you far superior returns because uh, 6 years later, you're right, the risk profiling was something similar, but return profiling was very different. Now, we think this is a very unique where you're talking about low risk appetite client, low walls product, but in a unique manner can take advantage of short positions in the market, low risk on the side. So that gives you a big edge. Excuse me. Just from my explanation point of view, equity arbitrage, we can go up to, if markets are bad, and we think market is going to be very challenging, we can even have up to 65% complete arbitrage exposure. We can have unhedged exposure, okay, on the long side to the tune of 40%. Obviously, on the unhedged exposure or the naked short to the tune of 25%. It's a good combination of debt, arbitrage, low risk strategy, and which include options writing in a big way. You can talk about any low risk derivative strategy without getting into details. Okay, we can optimize. We as a house also specialize in predictive analytic. The predictive analytic thesis gives you a perspective. You are not only predicting the direction of the market in the option side when you run forecasting the employed walls or the volatility expansion, all compression will also makes a lot of difference. We say as a house who have a lot of prop experience in the past believe that we have significant edge in understanding the volatility of the market. In fact, a lot of people say, let's market settle down, let's volatility settle down. I will participate few percentage or 5% higher only, but I want this dust to settle down. Our entire perspective as a house, we think we thrive the volatility. We always say, make volatility your invisible animal, your best friend, then you will be at ease. And that's the important, because it's a mindset game which people play on the volatility side. People get unnecessary panic when extraordinary choppiness is there. We as a house have always demonstrated extraordinary choppiness means extraordinary opportunity to trade both the side of the market. And that's the way we think equity long short product and even hybrid long short product should be a unique opportunity. Let's look at the performance, whatever we can talk about. So if you really look at industry benchmark, negative 0.37%, we have delivered 10.6%. 3 months, 6 months return, very, very unique in the sense decisive beat on the benchmark. And again, this is in the 6 months perspective. It's the best performing fund in hybrid category also. So all three products which you showcase so far, they are best performing in last 6 months in the category as a whole. Now let's talk about uh, interesting product, the long short multi asset. Now, this is a very interesting product according to us. You have seen the success of our own multi asset fund on the mutual fund side. It's a very unique product. If I have to compare our quant multi asset fund, okay, as compared to industry, or we compare to the benchmark, or even you compare with anything on the indices, whether you talk about small cap, mid cap, large cap, any sectoral indices also. This scheme 1, 3, 5, and 10-year horizon has done extremely well. It is a top quartile fund, comparative on any parameters you look at and hence we expect that risk adjusted returns in the multi asset is best in the industry and within the quant also is the best. And now we are extending this multi asset fund, this map as a concept, the long short map we're talking about. Here we get huge advantage as a money manager. Not only on the flexi side, you can have complete flexibility on the market cap rotation. We have the advantage of rotation on the sector side also, as well the asset class. So asset class diversification gives us huge advantage. We can optimize the opportunity on the crude side, natural gas side, or you talk about any other commodity except the agri commodity. And we have already taken exposure in the multiple times for gold, silver, crude. We are able to capitalize very recent opportunity. So it's a very unique product. We can also look at doing a arbitrage in this product in the gold, silver. A lot of people made in last 1 year big amount of money because extraordinary spreads was available and which you cannot optimize through mutual fund route. Here we can play that. Now, the point which we are trying to bring out here is let's understand the in terms of asset allocation, how the portfolio aligning would be. So obviously, we have potential to get into 35. We have to maintain 35% debt component out here. We have to maintain 35%. So that's the reason we can go up to exposure of 35 to 65%. We can have arbitrage exposure. As I explained here, the only thing differentiation you have to understand on the short side, we can only hedge derivatives through equity or as well as debt. Regulator has not allowed as of now any shorting on the commodity side, and I'm sure we are have also represent should be addressed soon. But we have option or luxury to hedge our exposure in the on the commodity side also. So net, despite this freedom is not there, but it's a very unique opportunity as a money manager. We always say which is the product which you believe gives you highest flexibility and where money management can really demonstrate their skill set. For us, this is the one product on quant side, and the qsif active asset allocator long short fund gives us huge edge as a fund house, as a money manager to optimize and play on the both the sides and all asset classes and across market cap. So it's a very interesting product from our perspective. Now let's look at the performance side. Even this fund has not completed 6 months, so last 3 months, 14.2%, 1-2% return, very, very high, where benchmark is flat to negative. 1 month benchmark is 1.92, we have delivered 8.26%. This is also one of the best category fund and this in terms of performance in 1 and 3 months perspective in the respective categories leading the chart in that sense. Now, sector rotation fund. This is the last one which we have launched. Now, this schemes is very differentiated. Now, it has certain limitation because you can only invest in 4 sector at a given time. You can have 3 long sector, 1 short, or 2 long or 2 short, or vice versa. Okay. You can also have 3 short and 1 long. But the challenge which we face as a house, it is defined by amphi-defined sectoral, and that becomes sometimes challenging. And let's see if it get modified over a period of time. The way I look at this product globally, when you talk about a long short pair, this is a very apt product for a pair strategy where we are bullish and bearish on particular sector. We can run long two sectoral and short two sectoral. This is the product which is slightly not on day-to-day basis, but if I could look at 3 months, 6 months perspective, if you can form opinion in next 1 or 2 quarter perspective, this is the unique product. But however, the volatility can be higher than other four product which we demonstrated because of the skewness of the sector and the limitations of the sector which we have. So that aspect you have to keep in mind. And once we are able to optimize one cycle, okay, or for various sector, then can be a very unique opportunity where you are able to make money on the long side, you're making money on the short side. If that happens, it's a deadly combination, but it's going to be challenging initially. Let's see how it's materialized in terms of stock selection process, which we are building. And I always say any new product comes, it takes 3, 4 months at least to start a product. And 6 months is a good timeline to understand how you perform. And I remain confident the entire QSIF category in 3 years or 6 years later, you realize something important if you have missed this opportunity. So let's understand these are the various four scenarios you can build out here in terms of sector rotation fund. Now let's talk about why quant as a house are is more apt for a QSIF strategy. Okay, if you really understand our own background, before starting our mutual fund, we used to run one of the biggest prop desk in the country. And 15 years, from 2008 till 2018, for nearly 10 years, we ran that product. And size used to be very large. We used to do every day $1.5 billion turnover on exchange, both on the currency front, commodities front, particularly gold, silver, and on the equity side also. So in 10 years, we never have yearly losses. Okay. We never had even quarterly losses as compared to the industry. And what is interesting in the Lehman crisis in 2008, that 45 days, we actually made good amount of money with a very insignificant capital. We generated 18 crore rupees. So it gives you a track record, which we have. Our capability on the understanding long short strategy, A, the experience. B, we talked about high frequency analytics. Since we as a house has invested nearly $24 million in building our own analytical platform and risk management tools, which is really helped called Quantum Mind, which is really help us. I think one of the important reasons we have seen as we launch our SIF product, our mutual fund performance also has improved because so far we were only looking for long SID. And now when you have a QSIP product and our advantage, the same team runs both the product because we have experience in running this product. We are first when we are in the process of identifying short ideas. The first strategy is to cut down your long exposure in some of the schemes which you have. You're turning negative on particular stock of sector. That's the one advantage which we over a period of time. And B, what is important that we are all ultimately all human beings. We have been practicing only long side exposure for last many years or so. And suddenly you say now you have to look for the short side. It takes time to digest. That's the reason quality of talent is a big shortage in the industry. And a lot of people are not able to accept this challenge. But we as a house believe the youngster will drive this product because we remain confident that young team will over a period of time in next 3 to 5 years, we're able to build their capability in the entire industry. Today, there's a shortage of quality manpower or money manager in or respective long short analysts in this country. But from a longer term perspective, the small background how we have built our edge in the long short strategy, and we are running this product for a long period of time. Now, the way you are familiar with our VLRT framework in our mutual fund side, here that is a low frequency analytic which we build or discretionary active. Here we're talking about systematic active, and we have built the thesis of Markov. And Markov is predominantly high frequency analytics where we get into very details of the market. Let's say today we're talking about weather is changing on continuous basis. It's a high frequency indicator. Okay. You're talking about open interest data, price data, volume data, or the trade data, which is changing minute to minute, rather second to second basis of the screen. That is a high frequency analytics. The entire thesis of QSIP, the high frequency analytics space we talk about we talk about objectivity analytics or risk analytics or alternative data. With today's an AI world or ML world, alternative data analytics becomes very easy. Cycle analysis, something which we are very proud we have built. Volatility analytics, something which we briefly talked about. So this is a small thesis. I'm not getting into detail. Maybe do some other day we can get into a conference. The last slide on the clarity from a perspective, how we as a house are clearly differentiating between our mutual fund as well as a QSIF strategy. So in a mutual fund, a discretionary active strategy called VLRT framework, low frequency weightage 70%, high frequency weightage 30%. Okay. In Markov or systematic active investing in the SIF front, 70% weightage on the high frequency and 30% weightage on the low frequency. That's a very clear differentiation how mutual funds are going to run at quant and how the SIF will going to run, or the QSIF, what we call it. It's a very interesting name, QSIF. Now, this is what we already explained. This is the thesis about ideal allocation in next 5 years perspective. 50% should be mutual fund, 50% should be QSIF type structures. And that's the way it gives you a better positioning of the market. Now, I'm not getting into all these details. The important aspect is there the you can play both long short thesis. This is something you also as an investor and distributor change your mindset. There's something new has come and we have to accept this thesis. Now, what is important for us to explain you these theses, what it ultimately leads to when you combine both the things, as I explained, reduction in volatility, enhanced diversification, lower drawdowns, and source of additional alpha. The source of additional alpha, where I'm again emphasizing, that's the real skill set of money manager comes into picture. If you're able to generate alpha by shorting the market, and that will be a game changer for this industry. And okay, this is the way we are looking, and we are not looking at arbitrage plus a small opportunity. There's a huge opportunity available if you can do 25% naked short. And I strongly believe if entire industry behaves in a mature manner and this becomes successful, so far the track record is pretty decent. We're happy to share that. Then I think regulator will not be hesitant to even increase the limit to 50% and or higher on over a period of time. And that happened, that additional source of beta, then you are really talking about a great risk-adjusted returns product or superior risk-adjusted product, huge flexibility. And with the mutual fund taxation, what else you want? This is the best product according to me SEBI has given to us, and we are very grateful to the regulator.